Financial disclaimer. The information provided in this stream is for educational and informational purposes only and should not be considered as professional financial or investment advice. We are not licensed financial advisors, and the content presented here is based on our personal opinions and experiences. Investing in stocks and other financial instruments involves risk, including the potential loss of capital. Any investment decisions you make are solely your own responsibility, and you should conduct your own research and consult with a qualified financial professional before making any investment choices. The content we share on this stream may not be accurate, complete, or up to date. Market conditions and financial regulations can change rapidly, and we cannot guarantee the accuracy or reliability of the information presented. We do not endorse or promote any specific stocks, companies, or investment strategies. Any actions you take based on the content of this stream are at your own risk, and we will not be held liable for any losses or damages that may occur as a result. Always remember that past performance is not indicative of future results, and no investment is guaranteed to be profitable. Make informed decisions and consider your risk tolerance before investing any funds. By accessing and using this stream, you acknowledge and agree that we are not responsible for any investment decisions you make as a result of the content presented. You are encouraged to seek advice from qualified financial professionals for personalized guidance. Please invest responsibly and only with money you can afford to lose.
Hey man, just found the next guaranteed multi-bagger.
Hey man, you found another one? What is it this time?
Come check this out.
Hey, what's up everybody? Welcome. Happy Saturday. Sadly, Redneck Johnny's not able to make it today. Apparently he was out partying too hard last night. So looks like it's just Ranger Dane on this Saturday morning. Maybe he'll join in at some point. I don't know. But either way, I think there's some good stuff to talk about today. So I'm pretty excited about today. If you watched previously on the streams, I know Johnny touched on it a little bit last time. Barnes & Noble Education had a huge sell-off. And I actually took that as a very bullish signal after doing my own research and trying to dig back into it. I was obviously bullish before the news came out, which we'll dive into everything so I can just kind of give you kind of my thought process and how I look at something like this and basically where I think this is a reasonable risk to take. Now, obviously, it's a very risky stock in terms of what actually needs to occur for it to work out. But I think it's just enough that I'm happy getting a position into it. So I did take a position just to be upfront with everybody, and then we'll go into that. I'll kind of explain what my thought process was on it, and like I said, I've been following it for a while. So this is kind of the important part about following a story, because it allows you to know that when something drastically changes, to be able to really understand what's going on and do your best to assume what that's going to do in the future. But we'll and then after that we'll go through the dashboard and just a typical normal day. Like I said, not sure if Johnny's gonna make it on, but either way, doesn't matter. We'll get through it with or without him. He's out there partying too hard as always. But just looking at the dash just to go over stuff. This is ending of yesterday. It's a long weekend here in the States. We got Martin Luther King Day on Monday, so the markets will be closed. So I still do plan on doing the stream on Tuesday. We'll get caught up after that. See how the weekend went. See how on Tuesday. See how that day goes. All right. Of course, I don't have off on Monday, but whatever. For most people, I'm sure you do. Hopefully, you do. Enjoy it. Looks like in terms of the market moving, stuff's bouncing around. Bitcoin pulled back after some of the ETF news. I was actually kind of surprised. I thought that would be a little more bullish of a move for Bitcoin, but you can see kind of everything bounce back, which I don't know. Maybe people were taking money and shifting into an ETF. That could be why. I honestly have no idea. But, you know, MicroStrategy was down. Gold miners are up a little bit, nothing crazy. Natty Gas is still up, natural's coming back. So if you follow any companies that look at natural gas, we're starting to get some numbers back up here, which we are starting to get into really the colder months too. So it's not surprising to me that you're going to start to see that. Shipping's obviously still a big concern. Looks like a few countries along with the United States now are starting to, I'm not sure what it's like the Houthis or however you say their name. It's like a militant group that's basically been pirating in the Suez Canal. So a bunch of shipping companies, which I talked about CTRM, and usually I just look at Maersk. Maersk's a pretty good idea of kind of what's going on with shipping. You can see this week it had a little bit of a pullback. If we go to the daily, you can see obviously that over the past month or so there's been quite a bit of a rise, just because of the fact that ships have to go now around they're choosing to go around the Cape of the Horn of Africa. So just that extra, I think it's an extra 10 days. It takes the trip at least from like Singapore, which I'm sure is most of the shipping that's probably coming through there. But if they're going all the way up to Denmark, then that's an extra 10 days. So cost of all this stuff's going to go up. So it's just part of how it is. How much it affects and continues going forward, I'm not sure. I'm not sure if some of these countries kind of put a kibosh to the attacks and are able to maybe defend that area of the world a little bit better, maybe that'll pull back. Whether they should be over there doing it, I'm not getting into any of that. It's not what this stream's for. I just look at it in terms of how do I think it affects the market. That's the news, or that's what I'm trying to understand about it. Uranium's up again. Uranium, like I keep, that's another one I keep pulling up that I feel like is relatively bullish here. I mean, this is these moves, they just don't stop going up. So, and now we're getting into oversold territory. So maybe we'll see a bit of a pullback. I mean, that was a pretty big jump in the past few days, but I know there's someone on Twitter that's it's someone I follow. They're super bullish on uranium, and he's been calling it way down here. And I mean, even in an ETF like this, it's a double. So it's pretty impressive. And of course, it looks like all my Excel stuff just crashed and reloaded. So I might have to just reload those at one point. But let me see what pulled up here. Untrusted. Microsoft's blocking macros. I don't know why it would do that. Untrusted. I'm not trustworthy on my own stuff here. Doesn't matter. Maybe we can, I don't know if we can use these. No, because now they're all going to be labeled wrong. I got to just, hang on. We'll adjust these. While I'm doing this, it's not a big deal. We can get a little bit into Barnes & Noble Education. Obviously, this is the one that, in my mind, is the big stock of the week. It's the one I'm bullish on, and I think I think the news is definitely overblown. Now, is there risk involved in this? Obviously, but if you've watched the stream before, you know that I do take relatively heavy positions. With that being said, I always have stop losses engaged. So anytime you're looking at companies that would be considered super volatile, and you're really going off some theses. You have to have that kind of thing in place. You can't take massive losses. When you're wrong, you're wrong. It's okay to be wrong. And this is the whole thing. You're just balancing. At least I am. This is the way my style is. And just as another disclaimer to everybody out there, if you're watching this, it's important to know what your level of risk tolerance is. My level of risk is probably much higher than most people. That was just kind of part of what I wanted it to be. Sorry, I don't know why I bumped this to super small again. Zoom back in here a little bit. But you have to understand your own risk tolerance when looking at companies. So like I said, my style is I'm just doing simple law of averages. I'm finding things that I think could jump 50% or more. That's kind of my threshold of companies I look at, which obviously makes me tend to look at very volatile, a lot of nano and small cap stocks. Sometimes I look in mid cap. It just depends, but I tend to find that large cap and anything bigger than that, you're not going to see big moves unless you're really holding them over time. Which at some point, I think you have to get to that point where when you're looking at those kind of companies, you have to just kind of really start thinking more about the business and staying in them for the long term and finding great businesses. I do agree with that. But while you're smaller as a retail investor, I just don't think you have to. I think we have so many more options to be looking at some of these things that aren't quite so crazy big. So with that all being said, you know, this is something that I've bought into, but by no means is this a buy recommendation. I'm just going to give you kind of my idea on it, and then from there, it's always important to do your own due diligence to make sure that it's something that you would agree on, or you might disagree with me. You might even start shorting. Go for it. I'm not saying you're wrong. You're probably right. If I'm buying it and you're doing the opposite of whatever I'm doing, that's probably a great move. But either way, that's why I said, you know, I just put some stop losses in place. If I lose 10 or 15% on a choice that I made, but you know, any of my wins are over 50%, it all balances out. So far, that strategy's been working great for me. And it's similar to, you know, I've you know, taken my ideas a lot from RK in terms of the way he balanced risk. I tend to go even more concentrated than he did, so my stop losses are really important. And actually, you know, part of what gave me the confidence to even do this kind of style is this is similar to what Burry would do. So if I can see someone at his range be able to do this, and then just accept the fact that no matter what, no matter how many things you understand about a stock, you know, no matter what you know about valuation, it doesn't matter if there's going to be times you're wrong. You know, it doesn't matter. The market doesn't even have to react rationally to anything going on. You know, they could come out tomorrow and blow free cash flow out of the water, and it's like the best news you ever heard. But at that same time, it doesn't matter. No one cares, and the stock drops 30% for seemingly no reason. So that's just part of what it is. So you have to just kind of accept that when you're dealing with equity. You know, if you don't like that kind of thing, then buy indexes and bonds, and just, you know, enjoy this for entertainment, because that's really what the point of this stream is. As well as, though, I hope it to be educational. And with that being said, too, I have a few friends who were talking about tuning into the stream. At any point, too, if you guys have questions, I'll do my best to answer anything. You know, obviously, I'm still newer to finance, but I've been reading and learning for years now. So I do have most of the basics down. And I can at least explain my thought process, whether that's right or wrong, or you disagree or agree, that's up to you. But you can at least see the kind of the way I view things here. Just adjusting one thing here. All right, so we can hop into Barnes & Noble Education, because really that's the stock that to me is really the interesting one right now. Part of that reason is we can quickly pull up the old chart here. You're going to notice that there's been a massive move. You know, initially when I was looking at Barnes & Noble, I think by the first time I noticed it was in this 145 range for me, which honestly, I thought $2 around there was kind of what I got. I got just shy of $2 for what I would value it at. And this is with the success of the First Day Complete program, and looking out at least a year. Based on free cash flow and them being able to restructure the debt, which, like I said, I'll go into all that and how I'm viewing it. So it was just late enough for me that I didn't quite pull the trigger and take the position, and it kept going up so quick that then I was thinking, well, maybe if there's a pullback, I'll get interested, and it just wasn't happening. And seemingly it crossed past the $2 mark, and I'm like, oh gosh, I'm like, this could have been an interesting thing to get into here, and all that was happening, everything was going great, at least, you know, on a superficial thing, and then one news story comes out and it changes everything. And I didn't notice it until the day of when the big drop was happening. I think it was down, the first time I saw it was down like 30-something%, and I was like, whoa, what happened here? And like the news was kind of cryptic. It was almost like hard to find. It was a USA article, which I'll pull that up. We'll you know, I just do some stupid lines here, but we'll get into that at some point. It doesn't matter, no one cares. But it was on USA Today, and the big news basically is that the Biden administration is talking about, you know, ways to save and help college students, just because college student debt has obviously become such a massive problem these days. One way that they were talking about doing it is what I'll read here. They're talking about another change that would end automatic book fees. So a separate change would prevent most colleges and universities from automatically charging students for books and supplies. Under current rules, schools can include fees for books and supplies as part of the required bills for tuitions and fees, even when students can find materials at cheaper prices from other sources. The department's concerned that the lack of disclosure and transparency limits students' ability to find less expensive materials or access if their school is offering the most affordable arrangement, the proposed rule says. Advocates for textbook affordability lauded the move. current state of automatic billing programs mean that in some cases students are charged for resources they could have gotten at a better price. Getting charged for something that you can get for free, that's the definition of a junk fee, he said in his email. In another letter, this guy said that the proposed rules consumer-friendly positives, and they will help more college students pay for school. These efforts are just another step in improving the higher education system and ensuring colleges are providing all students with high-quality opportunities for upward social and economic mobility. So, with Barnes & Noble Education, what they are is they're bookstores that are located in colleges. They're all across the United States. I think there's about 700 or so, and they started a new process, and it's called First Day Complete, which we'll hop into that now. Let me just find this one here. Okay, so this is from their 10Q. I think it's the most recent 10Q, and just wanted to kind of go into this just a little bit to explain to people so everyone can kind of have an idea of what the First Day Complete is if you've never looked into this. So what it is they are one of the largest contract operators of physical and virtual bookstores for college and university campuses across the United States. They're one of the largest textbooks wholesalers, inventory management, and hardware and software providers. And they deliver this to about 5.8 million students, which is a pretty sizable amount. The strength of our business includes the ability to compete by developing new products and solutions, blah, blah, blah. Let's get to the more important part. We offer BNC First Day equitable and inclusive access programs consisting of First Day Complete and First Day, which provides faculty-required course material on or before the first day of class at a discounted rate as compared to the total retail price for the same course materials if purchased separately. The BNC First Day discounted price is offered as a course fee or included in tuition during the 26 weeks leading up to October 28th, 2023. BNC's First Day total revenue increased by 72, I believe this is in thousands, or 39%, to 261 compared to 188 during the prior year period. So obviously the idea here is that they're wrapping and making this more convenient. It's cheaper because of the way it's done. It's to benefit students, and it's to make it easier for them to get access to the books. And yes, it is a wrapped in fee, which is why everyone got so worried when the news article came out saying that, you know, it would directly attack this program. So that's why all of a sudden you saw this huge drop off, because the big seller was the margins on this First Day Complete program are excellent. If they continue in the same way that they're moving, they'll generate enough EBITDA, which will translate into free cash flow, which will help them to restructure their debt, because the big concern with a company like this is they got quite a bit of debt, and this was kind of like this might have been their last chance for management to kind of get into a position where they're going to be able to handle getting that debt under control and also become a profitable business, which is why you started to see the share price react positively before the news came out. Just to continue through here, so First Day Complete's adopted by institution, includes a majority of undergraduate classes and on occasion graduate classes, providing students both physical and digital materials. The First Day Complete model drives substantial greater unit sales and sells through for the bookstore. First Day is adopted by a faculty member for a single course, and students receive primarily digital course materials through their school's learning management systems. Offering course material through our equitable and inclusive access First Day Complete and First Day Key models is a key and increasing important strategic initiatives of ours to meet the market demands of substantial reducing price to students, as well as the opportunity to improve student outcomes, and obviously they benefit from this. So it's basically allowed them to reverse historical long-term trends in course material revenues declines, which have been observed in those schools where such programs have been adopted, improve projectability of our future results. We're moving quickly and decisively to accelerate the First Day Complete strategy. They plan to move this to even more institutions in 2024 and by most of the schools by 2025. So this is where all that extra revenue would be generated and where this could really turn around. And if they started to generate these numbers, even if they can't necessarily pay down the debt completely, they could restructure it, get out of the issue, because then, you know, when you're going to restructure or something, a bank's going to want to know what you're pulling in, because that's how they are able to kind of generate or or predict your risk in terms of what they want to give to you and how great of a term you're going to get, whatever you get restructured on. So in the fall of 2023, 157 campus stores are utilizing First Day Complete, which represents enrollment of nearly 800,000. It's an increase approximately 47%. So obviously this program was scaling up very quickly. So that's First Day Complete. It's the idea that it's wrapped in there. So obviously the news data or the news was going to be harsh on that. So this was an article written on Seeking Alpha, and it just kind of touches on one of the analysts' view on why this is a kind of a killer possibly to the I guess the narrative for this. So Needham analyst Ryan McDonald warned that the proposed changes, which call for a shift from requiring students to opt out to opt in, present a risk to the current margin trajectory of the overall BNED business. While BNED intends to fight the proposed changes and there will be a public commentary period prior to any final decision, we believe the regulatory uncertainty will make it more difficult for BNED to refinance its debt. Given this dynamic, we no longer anticipate outperformance from their shares despite their discounted valuation. So obviously the shares are discounted because of the fact that they're highly leveraged. Most people it's a little too risky for them to get in, or they're just not going to put a big enough position in because of the risk that's involved. Now, with that being said, one of the important things is this statement here, which require a shift from students to opt out to opt in. Now, the projections are based on the fact that students don't have to do this program, but they do have to opt out of it. So, for instance, if a classroom's doing it, they just say, hey, this is part of it. It's just automatic for you. This is the price for you. And if you didn't want to do it, you just opt out and say, like, nah, I don't want to do it. It's easier just to opt out of it. In this scenario, they would say, hey, this class offers it. You would have to opt into it. You would have to say, I do want to do this, which allows students to obviously go and look other places. So it's not a guaranteed revenue source. That's the big change here, and that's what he's saying. That's why it's just we're not sure at this point where it's going to go. This is why I don't think this is also important, and we'll delve into a few different reasons why. So this is from the most recent transcript, and this is one thing that I found particularly important. Alex Furman was asking this question during the transcript. He said, I believe that you said the First Day Complete dollar revenue growth was more than enough to offset the decline that you saw in the quarter in dollars of the a la carte course materials. If I'm not mistaken, I think this is the first time that you guys have said this. Does this move more or less mean that you've turned a corner? And from this point going forward, course material, required materials revenues should be growing. Exactly right. That's the numbers I cited were year to date. This increases in the First Day and First Day Complete combined program revenues versus the decline. If you look at Y in the axis and you think about it on the curve, we've now crossed the line now where the model change is inflected at the top line inflection, reversing the trends of years of courseware decline. It's very clear now that with the models that you combine those together, that we're reversing a trend of courseware sales decline from the a la carte traditional model, and that's just huge. It's clear evidence that strategy is working, and the other benefit is it's much more predictable revenue stream for them. Hold on, because I think that wasn't necessarily the part. What I wanted to... They were talking about the opt-in issue. Sorry, I thought I had put this on the right paragraph, and it must have scrolled because that wasn't the one that was so important to me. Okay, it's actually this one from Matt Shea. Sorry, it must have scrolled down on me when I was moving around. Just thinking about some of the newer programs and cohorts this fall, understanding it's no longer an opt-in model, but rather an include or opt-out model. You noted last quarter it was too early to gauge those opt-out rates in the new cohort of schools. Now that you're a little deeper in the semester, how have the opt-out rates trended, and how do you compare these to your internal expectations? You said we referred to it, and we did it in our comments at a participation rate, and the number of students that are participating and the participation rates are aligned with and even exceeding our expectations at our schools this fall. What we've seen that time and time again, I mentioned this, and not only do we see strong participation rates, but that schools participate in FDC year over year, those participation rates at those schools are actually improving as students who are freshmen, sophomore, experience FDC understand the convenience, the affordability aspect, the impact it has on the academic success, and the rates continue to get better with each year for each of those cohorts, which is an exciting development and even highlights more upside in the first day complete model for us and our campus partners. What that tells me is that the average student, even when they had the chance to opt out, the reason why they're staying in the program, the reason why they like the program is it's the convenience, it's cost saving, and what was the other one? And just their impact on their academic success is what he said. But I think, I was a college student at one point. I know what it's like to have to get your books on the first day of class. If someone just wraps that in, if I was able to just break the math down quickly, even if it's close to the price that I'm paying somewhere else, but it can automatically all be done for me and it's just delivered to me on the first day, you're going to take that option. I think you're going to take that option. And in terms of people, like, let's say you get into the class and you have to opt in or opt out, or you just have to opt in essentially. I think people are going to opt in. I think they're going to look at it and they're going to be like, maybe something will come out of left field. But I think this part here is one of the most important things in terms of me understanding what's going on here. When Courage was talking, he said he fired off a note to his group, which at some point he said he'll go into more. Another person on here is commenting this, Gandolfo. Maybe it catches a mean bid. He's just saying it's too risky, way too much debt. Even if they somehow pull off the EBITDA, this results in zero free cash flow. He's not doing the numbers, in my opinion, looking out as if all of them generated cash. So I don't think this comment to me is very thought-provoking in the fact that I don't think yes, in the current situation, they will not pay off the debt. But if you look at their most recent filings, we were cash flow positive. We're simple free cash flow positive. So it is turning around. The revenue streams are increasing. Things are going back up. If you're seeing all these numbers and everything's starting to come back up, that means the program's starting to show success. Free cash flow is going to start to come through. Now the question is, when can we pay off that debt? If we go back to the debt here, like I said, this one's due in 24, this one's due in 25. So the credit facility is the one that's most important here, and this is the one that we have to talk about restructuring. Now, there's a few things that go into this. In terms of a program like this affecting a school like this, it's got to go through a whole process to get this done. Even if they forced them, like I said, I don't think the issue would be even if this all happens. This is assuming that this goes through. It's assuming that this happens before Biden and the election comes up, and assuming Biden's still in the election. Who knows? I mean, that doesn't. If let's say either a different Democratic candidate gets in, or someone that's Republican, who knows if these programs would even ever happen? We don't know any of that. So these are all the assumptions people are making in their discount. And I get it. It's some kind of risk, but to me, there's so many risks going against this thesis actually coming through. And then once again, if it comes through, I think people would tend to opt in. I think the fact that you have enough students starting to already have done this, and you had a few years, you had positive revenue growth. I think all those things put together, it's going to prove that people are going to continue to opt in. People are going to take advantage of the program. It does save them money on digital materials and stuff. If you can find that it's cheaper to do it that way, unless the Biden administration could propose something that would be drastically cheaper than what this model is, I don't know how they would do that. I don't know how they would benefit. I mean, no matter what, you have to make money somewhere. People don't write these textbooks and go through all the trouble of doing this without, thinking just at least they're going to get some money back. And I think if you started to put limits on what people can make when they're writing and coming up with these course materials, you might actually dumb down the course material because people aren't going to put as much effort into it because there's not as much profit possibly involved. And I get it. Some of the textbooks are kind of BS, and some of the books you barely read in the classes. And if they want to, cone down and focus more on that kind of thing, that makes sense to me. But I don't think people would tend to not opt in on this model. Now, that's obviously the risk to the thesis, and we'll have to go forward and see how this affects. But I don't think that this news was strong enough, in my opinion, to even come close to warranting this kind of a discount. So with that all being said, I decided that this risk was totally warranted. So I did, like I said, I did take a position. It's a relatively large position, and I just used some basic technicals to kind of get in. I saw the price drop, and I was watching that next day, and I had calculated just based on just some fancy lines. This is the genius of my system here. Just some support around 105, and so I ended up I put a bid in at 107, and there's obviously some resistance here. Then I see at 130. Now I get it; it's technical analysis. It's just something to just throw in for the rest of everything. But I think if we can break through that 130 mark, I think it kind of proves that the thesis that this is all going to fall apart kind of gets broken down. I think people start to realize that, that one news article might not be a big deal. It could be. I'm not saying it wouldn't be, but I'm just saying I think here the risk is very calculated. And like I said, I always put a stop loss involved. You just have to, everyone can do their own research. They can read through here. They can try and do the math themselves on the rates that they talked about. But if you don't think that they can generate enough free cash flow based on the rates that they're talking about, I would like to see where you're getting those numbers. The only thing I can think that would break that thesis is that you're saying that you don't think enough people are going to continue to opt in. Otherwise, if they continue to opt in at the numbers that they're doing, or all this falls through, this was a discount for no reason. This allowed me to get back into this position, and so I was excited. To be honest, I saw the drop, I saw the news, and I was like, what is going on here? But this is part about being contrarian. People overreact. The market always overreacts to news. So hopefully, this is one that I can prove to you that this kind of thesis and this kind of way of investing is can be very successful. You do have to do your own homework. You can't just guess on these things. But if you do it in a calculated way, whatever that risk is to you, I think you can approach these things and make some decent profit off these kind of things. Yeah, I'm pretty excited about this one. Like I said, I think it's overblown. I think well, in one of these replies here, Courage had wrote, trying to find it, might have been a ways back here because I think this was before all this happened. I mean, he's been talking a lot since here, but somewhere in here, at the current rates, he had thought that I think that they could generate. Yeah, he's saying that they just generated 61 million of free cash flow, and if you start looking at what the FTC model could look like on a 1.6 billion dollar revenue basis, it's not hard to get 75 million of adjusted EBITDA, which would make the debt easier to refinance and would generate a lot of free cash flow, which is basically also what I'm agreeing with. I mean, that's the thesis on it. So I'm hoping going forward, too, that as I find stocks and I get into these things, because some of the ones that I've gotten into have kind of happened right before the stream and whatnot. But this is similar to me to Ethereum. Sometimes it doesn't take much, but if you're able to follow this position, you can understand why a news story like that, how impactful is that on the actual business. And I just don't think it's there. And maybe it will be at some time, but I think at this point, you're assuming just as much, if not more, on the other side that this is going to material destroy the business. I don't think that's the chance, but maybe I'm wrong. Who knows? I'm also a moron, and I might be proved wrong on here on one of my first big calls on the stream. So if it happens, whatever. That's why you put stop losses in. Always protect your downside. That's why I follow a margin of safety. With the last time I had calculated it, based on some of my actual free cash flow adjusted measurements, I think I had got, let me just go to my database here just to make sure I'm telling you this correctly. I said 95 cents would be a buy, and I know it's a little bit above that. And when I say 95 cents is like my buy area, then I sometimes do play with technicals and stuff, and that's kind of how I use it to get into things. Maybe I'll go 10 or 15% above that, and then use that as like my stop loss. Is that's a way to get out. Sometimes I use 52-week lows. Just kind of depends on the thesis, and if I think I can value something at a decent margin of safety, I'll go with that. Now, like I said, there is a lot of debt involved in this company. So it's not to say it's not without risk. So please do your own due diligence. Don't just buy this based on anything I've said today. But I thought this was a reasonable one to hop into, and I'm excited to see what goes on here. Win or lose, you're going to be right and wrong. It's not a big deal. But so that's where I got with Barnes & Noble Education. But we can continue on. This is some stuff I had pulled up. I haven't actually updated the whole system for what happened yesterday. So these are some of the stocks I saw that were interesting for me from Wednesday and Thursday. And then when we get through these, we'll hop on. We'll do the ones from yesterday. We'll go through the screening process, pick some things out. If you've watched before, you probably see that sometimes you find a lot, sometimes you don't. But, this is, with me taking concentrated positions, I only need a few. It's not... it's just always tracking, just keeping an eye on things. If you ever watched RK stuff, you're probably going to see so many similarities, but I took a lot. I understood. I just thought the way he presented things made a lot of sense for retail investors. Very thankful for what he did and being able to replicate a system somewhat similar to his, and then to take all the other different valuations and ways and styles of investing that I've read about, and to kind of turn this into my own process. I find anything that you put enough time into, you can get good at, and why not get good at something that can potentially, make more money than almost any other career, as well as it scales up. That's the beauty of investing is, as you get higher returns, you can scale that up. And if you continue that, and I'm not saying it's any easier as you go up, it definitely gets more difficult, but, it's one of the few things that you can do that it doesn't matter where you are in the wealth spectrum. You can continue to invest and improve, your situation, whether it's for you or even your future family. But all right, we'll hop over to sats here. It's not enabled here. Let me just, I just got to refresh here because when this shut down initially in the stream, it's the first time that happened to me in a while. I keep getting some glitches here and there. I try and go through my macros and stuff and throw things to like Stack Overflow anytime I see errors now, just because I'm always trying to just nitpick things out because I'm not a great coder. I read it's back there. It's just a VBA book, on macros and just the basics, and a lot of that stuff's practice. You really got to sit there and code before it starts to make sense on how it works. But EchoStar is the first one I pulled up. I think the chart for this was relatively interesting here. We can close out of some of this stuff. There was a big return. You can see it got way down here. It got oversold back in November, which went kind of everything. So obviously strange, a big rise, huge gap down. So EchoStar is a provider of technology, networking services, television, entertainment, and connectivity, offering consumer, enterprise, operator, and government solutions. It's EagleStar, Boost Mobile, Boost Infinite, Sling TV, Dish TV, HughesNet. So all of those companies. So this is just like kind of a conglomerate that's slowly been working with all these different brands, essentially. It offers broadband network technologies, managed services, equipment, hardware, satellite services, and communication solutions to government and enterprise. And they're also slowly getting into 5G as everybody is. So, this one on just a book measured, per share, which I do everything by share. I know some people argue against that, but to me, as long as I kind of compare it to a few people in the industry, I'm okay with going by shares. It's fine. When you look at everything in that way, it makes sense, in my opinion. And it also allows me to discount it because, sometimes I adjust things by share count in order to get my discounts. Historically has generated pretty great cash flow. Obviously, we're down a little bit right now. Margins are down a little bit. Cash flow from operations is definitely down. Back in 17 and 18 had excellent cash flow. And that translated into some pretty great earnings. Let's see what happened with debt here. Debt's been on the way down. Assets are also declining, but I think revenue was holding somewhat steady. It's down a little bit, but we've kind of been around this area here since 19, you could argue. I mean, way back a while ago, they were better off, but you know, that is a ways back, and how much that material affects things today, who knows. Still spending, you know, still using or spending a lot in CapEx, but that's just kind of the nature of the business. Depreciation's down lately, so I would like to, when you're dealing with a company like this too, it might be good just to peer into what that depreciation actually is including, just to give you an idea of how much that matters, and are we at the front or end of some of those in terms of their timelines. You know, it's even relatively positive on a net cash flow basis. Simple free cash flow is still positive. You know, I could easily say that even on the low side, I get $20. I think that would be a super conservative estimate, would be 20. And you're going to see these calculators over here. You know, I know you guys have seen me look at this, and it says 37. You know, I'm not saying it couldn't get up to there too. But this is just what you get from the basic numbers, which is it's only so much you can do, but it's great to always start with the fundamentals. I think it's super important to get that picture in your head. They don't have anything due, it looks like, currently, but they do have liabilities, obviously, but they do have a lot of cash on hand, which is always a positive. I actually just want to check the most recent SEC report just to see how accurate everything is. Got a lot of filings. Big company, though. Yeah, so they have the $1 billion in cash, just $1 billion just hanging out. So long-term debt is at 1.5 basically. Some leases. They have a few different little forms of common stock, but that doesn't really affect anything materially. Just always like to look at the cash flow here. So depreciation's down a little bit. You'd have to obviously delve in a little bit more to what's going on there, which sometimes in the notes to financial statements, it lists it in here to give you an idea of what those are and how they're getting those numbers. It's one of the numbers I feel like you could play with, especially in a company of this size. I'm not seeing anything here that necessarily catches my eye in terms of, obviously net income's down a little bit. That's probably the one number I would take away from there. Just like to take a look at the notes. 5 1/4 senior secured notes due 2026. If you guys don't know about the structure of debt, there's debt basically just gets structured, and sorry if this is boring to some of you guys who obviously know finance well enough, but you know, senior means it's the highest level of debt. It's the first to be paid back in liquidation, and then from there, when it's due is important. If it's secured versus unsecured, usually you get a better rate on secured stuff, just because it means that there's some asset basically that they can take and you know, to hold as like a leverage against it. Unsecured means that they don't have that, so they tend to charge a little bit higher. And you'll see a lot of companies tend to do like a mix like this. And then it's always important to know the covenants, which are just basically things that can trigger if you break a covenant. Like, let's say a covenant could be that your assets to leverage ratio is such and such, or your free cash flow to leverage is a certain ratio. If you break those ratios, the debt can become due immediately. So those are always things to pay very close attention to. So all this stuff's due in 26. So we got a few years to actually worry about what these amounts are and making sure that you can pay them. Now we're talking 1.5 to have $1 billion in cash. So probably not the biggest, you know, issue in the world. And the other thing too with some of these notes, They can be bought back at certain times. That's all written in the structure of the debt. It's a thick book, but if you ever want to really do a nice deep dive into how all this stuff works, security analysis is great for it. The whole section on all debt is excellent. But we'll go back to let's see what some people are talking about. I'll check insiders. We'll see if anything's changed. Obviously, there's been some news going on here because these jumps don't just occur. So 30 sets up for a post-merger spectrum moves for. So they completed their merger with Dish Network. So okay, so there's a lot of mergers and stuff going on here. Comes amid funding questions. So it looked like there was future funding worries, which was the drop, and then this merger with Dish has restored people's confidence. Once again, I'm surprised with the amount of cash they have on hand that people are so worried about the risk in terms of them not being able to pay that back. Granted, I get it. They have $1 billion and they got $1.5 billion, but they got 2 years. And if you had looked at the rates that these have been going up, like their cash, they generated a 300, and then I'd have to look into how Dish affects all that. That's the other thing too, is we're gonna have to dive back into this one once the next 10Q comes out, because if they just merge with Dish, all that information is gonna be put together. I could go into Dish now and try and calculate it out. It's probably a little over my head, and I'd be making a ridiculous amount of assumptions doing that, so I'm not going to do that. I'm actually surprised with this saying levered that it doesn't want to give me any kind of discount here in terms of shares released. So and they are buying back shares. I mean, they almost got to 100 million and we're back down to 84ish, 83, 84. So it might be 83 something. But let's just see. Currently trades at seemingly favorable valuation it faces for. So what was he getting a favorable valuation on? His debt load is more manageable, just 1.6 in debt against 1.9 billion in cash. So when is this article from? Because he said 1.9 in November. So have they got more? So they're just worried about the overall competition in the market, and are they continue to keep generating revenues? Because if they don't, that cash that they are going to need coming up could become a real issue, and then they would have to dilute or restructure that debt. And as you guys all know, we're not in a great rates environment, so when you go to restructure debt, if you have to do it now, that can kill you, because then your interest rate can kind of get screwed for a while on what you have to pay on that debt. So he's saying, noticeably, the company grapples with fierce competition from established industry players. Furthermore, significant risks are associated with their contractual obligations for satellite capacity. Should existing customer contracts be prematurely terminated before their scheduled expiration, that's a looming threat that EchoStar might not rake in enough revenue to offset the costs associated with the satellite capacity. So, they're worried that quickly combined entity private at a lower price, satellites and consumers have a significant value to capable management. So you're not generating that revenue, then you're not generating free cash flow, you're not generating cash in general. You can't save that to use it what you need for. But they did complete the merger here. I just want to see what the comments are on this. Acquire them. So people are mostly thinking they're going to be acquired. Obviously, there's a lot going on here. Changes in telephony between. I wonder if legacy telephony might take a look, but I admit that's a hope. It's not a strategy. Yeah, and that's the other thing too is whenever people are talking about things being acquired and whatnot like that, it's you never know. You don't know unless you're an insider. When someone purchases like a shitload of option contracts right before, that's probably like the best red flag you can get or something. Whether that's bullish or not, it just depends. But if they're buying puts or they're buying, You don't have an idea of what's going on there. So in addition to the completed merger, Dish said that 2.375% convertible notes due 2024, 2025 have converted into shares of EcoStar Class A common stock. So their convertible notes are all going to change into common stock. So that stock number might go up. So when you have debt can be convertible. So what that just means is there's an option usually at some price to change your stock or change your debt, whatever. Let's say you owned one bond or one note. It's essentially the same thing. You could, let's say you could change that in for 10 shares at this price. So it just kind of gives you a little bit of wiggle room. It makes the debt a little more interesting because if the equity does well and you're protected on your downside from the debt, but if the equity does well, you have this upside that you don't necessarily get with normal debt. So sometimes convertible notes, if I was ever going to be buying something, those are the ones I'd be picking through, is stuff that's convertible and has different clauses and that you can turn it into, because that's where you can find like some interesting deals. Or I don't know, it just protects you. It gives you more upside. Why are you not buying something? And the good thing is it tends to make the debt trade at a fair valuation. I just wanted to go to Yahoo real quick and just see what their share count has become, because this will probably be a little more updated than mine. Yeah, so now shares outstanding are 140. So shares outstanding are 140, but implied shares outstanding are 271. So that might actually be the real share count now if all those convertible notes got through. That's the one thing I'd have to figure out here. So the numbers that I see here could be way off, because if this number now is 270, you got to divide everything, drastically here. Because if this stuff is by share count, let me just see what this would be here. It's 31%. Yeah, so that drastically drops my my price here to $11 in terms of what a potential upside would be. So this one's interesting. But like I said, all this would get dropped right down, because if you're dividing it, and this is why I like to divide things by share count, because it helps you to understand in comparison things. Now, it doesn't always work industry to industry, but within industry, I think it's a pretty, it's decent. We'll go with that. It's decent. It's a good way to look at things. And like I said, I can always adjust things based on the leverage. It's interesting. So Dish got rid of all their, I'm assuming that was their debt. So by the merger, and just increased the share count here. So I'd have to see. I wonder, with Dish coming in too, is the revenue streams from them decent enough that it will help them guarantee that they have their free cash flow to handle their debt load? And really, yes, there's a dilution here, but if they're able to get that debt load under control, then you start to pay that debt off, you have extra free cash flow, obviously, and you can kind of protect this business for a lot longer. There might be a lot more share money being returned to shareholders. So who knows? Interesting either way. After all that, I can't remember what their ticker is. Sats. So we'll update this one. I'm not quite sure what I said about it last time. Actually, I'm going to put that $11 in here just because... So notes due 26 merged with Dish. I just put S&A, just means that there's mergers and stuff, splits, acquisition. That's my little code name, which makes me interested in that. We'll see. We'll see what comes out of that, but somewhere in there is where it would become interesting to me. And a lot of times these things, people will look at these numbers and they'll be like, it's got to be valued at more than that. or under that, who knows? And it's just to protect my margin of safety. It's a stupid calculation of things I do. Don't worry about what those numbers are. It's a pretty big company too, at 4.3 for a market cap. That's typically on the high side of something I'll be interested in. Now, if they paid the debt off and they continue to generate okay free cash flow, this would go up. This would drastically go up. So that's just something to take into consideration. I could picture, if you can pay that debt off, I could picture this book value becoming very reasonable, somewhere up to there. But actually, well, this was before the divider. So, well, like I said, it's tough because I have to wait until I get the information where it has all Dish's numbers included in here, because it's not included at this point. Yeah, so it looked like Dish was possibly going to go default, so the merger definitely made sense for Dish. Okay. I mean, I get the idea here. Once again, this is like the whole point. You're just trying to figure out what's going on here, so then as things kind of materialize later on, you have a frame of reference hopping back into this one, knowing what's going on. I think at this point it seems like I'm starting to look at all these companies. It's not like it's rare I'm finding a new ticker that I'm like super interested in, because most of the ones I don't look at, either the fundamentals are just consistently terrible, which I do need. That's one thing, is like I have to have some kind of fundamentals that I can go off of. I was joking around about making like a trading portfolio with super high risk stuff, but honestly, I don't know if I have time to dabble in something like that. I don't know if you guys have heard of VOXX, international manufacturer, distributor of automotive electronics, consumer electronics, and some of the things in the biometrics industries. They got about 35 brands, have major segments of those three. I know them for mostly, speakers, music, that kind of thing. That's what I think of when I think of VOXX. They do Bluetooth, sound bars, and for biometrics, it markets and distributes iris identification and biometric security related products. So probably fingerprint scanners, all that kind of stuff. So, but all electronic kind of things. It's a massive insider buy, which is probably why I initially noticed this. You know what? I never looked at insider buying I just wanted to check if EchoStar had anything. No. Okay. I did want to look back at VOXX. So Stephen Downing, who is the director, upped his ownership by quite a bit, at $10 exactly. And the way this is done is, it's on here twice, so I don't know exactly. What does the A mean again? Amended filing. So, okay, so the filing was just amended, which is why it came up twice. I don't know what the difference was, but who cares? It doesn't matter. Either way, he bought a lot of shares. This is exactly at $10, so I'm wondering if that was some kind of clause or warrant or something like that on why he got it exactly 10, unless that's just when he bought it. Pull up a chart here real quick just to see. No, it got around 10. So recent pullback, just looking at a longer chart just to get an idea. Going through all the fundamentals of these things too, sometimes you can just look at the chart and just to get an idea of how something like a company trades. All right, so some kind of buyback or share count's down a smidge. Positive on a cash flow basis, although on a 7-year cash flow adjusted basis, It's not impressive by any means. I mean, they're basically breaking even, and when you bring CapEx into the situation, they're not really generating much cash flow. So earnings this year have obviously been rough, which is why you can see that, that might have been more of a recent filing. Assets are down a little bit. That's high in comparison to cash, but it's not crazy in terms of the assets. Net income, it's been a few years now since they've had positive net income, so that's obviously a concern. Just general margins, just kind of looks like stuff's hanging in there. It looks like since 18, things haven't been great. Never paid a dividend. Book value is all going down, so that's not real promising. Mine gives a pretty steep discount here because of the cash flow. It's in my opinion, the price of something, it's going to vary, but you can go off somewhere about where the equity is valued, and then if you're not generating cash flow and there's not going to be shareholder return, that price, that value, or the value of that equity is going to continue to go down. We'll see what anyone is saying about this one. Hendrick's in here. He went from sell to hold. If you don't follow any of Hendrick's stuff, he seems like, in general, just kind of like a swing trader. But he writes great stuff. I always appreciate his input on things. I don't always agree or not, but he knows his stuff. He does this all the time. This guy's active, I'll tell you that. Company's business, VOXX gains a financially strong strategic investor. Is certainly good news, particularly when considering the company's current challenges. So they did repurchase shares, so that's where that share repurchase came in. It says they're continuing to grapple with a large arbitration award that the United States had given against them. Oh, that's right, with Seaguard. I had looked at Seaguard before, and I think it was one of the patents that they had. Biggest news in Tuesday's earnings release was the announcement of automotive supplier Gentrax Corporation purchasing a substantial stake in the company from President Beat Kali. Was that in here? Didn't I see that? Now he's selling though? In the exact same amount? He had purchased a ton though leading up to this. So maybe just Steven's just buying it back from Beat, but he had taken a substantial holding here at about $11, and he had been buying all the way from. Yeah, that's right. Okay, he had been buying all the way from the sevens. When is this article from? October 5th, 2023. Okay. So 50% of it is total holding in VOXX International Corporation, 2 separate tranches. He's just using VWAP for getting the pricing. So if it's less than $10, purchase price will be $10 a share, or so it's just the way he figured out how he would sell it off. So obviously working with biometric and automotive segments. So this where there was a bump in the in October. So this was the bump from that. It had gotten down to, this is when it was kind of touching some lows. No, hold on, I want to go back to that article. So he's just saying hold off that idea. No one's really said anything about that. So it looks like they just filed, and they did have both a beat in revenues and positive earnings. Shares were up on that news, but up and then right back down. That is interesting. What is the volume on that? So it's strange of such small volume here on the trail off, and it's selling right back off. So someone was, it was probably Henrik. He's probably trading it right there. Is that you selling off, man? Is that what happened here? All right. I don't know how much there is to go off this. I mean, that okay, it's at where it's at. Obviously the collaboration is interesting in terms of where it is. Poor fundamentals. I'll say good narrative just based on the fact of that, but it's still too expensive to me. I think it's GM. I'll just put Gentrix because I can't even remember what the ticker exactly was. Kali. Until I see a little bit more, and I get it, earnings are up, so these numbers will get adjusted based off those, but it's telling me that I need more. I need more before this becomes interesting to me. All right, we'll go to ULH here. Pretty good timing here. 7:40 right now, so I've been going for an hour. Universal Logistics Holdings, holding company. It's for customized transportation and logistics solutions, deliver value added on our dedicated transportation services to support inbound logistics to original equipment manufacturers and retailers on a contractual basis. Local and regional drayage moves predominantly coordinated by company management terminals using a mix of owner-operators, company equipment, third-party capacity providers. Operations aggregated in its trucking segments are associated with individual freight shipments, coordinated primarily by its agents using a mix of owner-operators, company equipment, and broker carriers. Okay. It's a long way of saying trucking. Let's see that purple and green. That's how you know it's doing well. It's a big insider purchase within the last year. I had put this on deck, so something had interested me. So revenues are up, down a little bit this year, but still up in general trend. 2022 was one of those years that it seems like a lot of companies had great revenues, so you can kind of just pass through the revenue, or you can kind of pass through that year and just see that, even if you go from 21 to 23, we're still up. So that part's bullish. It's considered safe, which means they don't have a ridiculous amount of debt, which is always good. And obviously they're generating great cash flow down here. They do pay a dividend. This actually seems like a pretty fair price. I could see why people pay up for this. It said it was at 45 at one point. Obviously, trucking is a cyclical industry as well. Coming off probably last year when things really looked great, because some of these numbers are probably a little inflated from last year, but it looks like they've kind of taken advantage of it. You know, they did pay that. What's debt doing here? I mean, it's down from highs, not down substantially this year, but is down. Assets are going up. Depreciation's up, but I mean, you're gonna have years where depreciation's high. In general, it generates solid income. Depreciation's kind of on par. Doesn't hold much cash, but it probably gets bought into things. And like I said, they're doing possibly buybacks or something here. And they are paying the interest on the debt fine. I'll have to figure out exactly what that debt includes. I'll just see who this insider was. This is the second company in a row now. You have all this weird information, just amended files. Sometimes when I get that on Insider, I'll go right to just go to see. All right, so he does own a significant amount. All right, so obviously owner benefits, and dividend price is somewhat stable, even in some of the uglier years. I mean, revenue in here dropped. Well, actually, it was pretty steady through this whole time period. It's more in 19, it more just went up. It's been a while since I had much to do with acquisitions, so don't really have to take that into account. We'll see what everyone's talking about here. I just want to keep closing some of this stuff because I have seen it. Sometimes when I rewatch some of the streams, it's moving a little bit more than I want it to, or lagging like a little bit more than I want it to. So you get to see my face and all these ridiculous pauses. Large client network agents and very cheap. Rating on Universal Logistics to buy. We're up from the lows, which it looks like back in October got down to 21. 21 would be a buy. That's that. If anybody got in, then great time to get in. This is from January 4th. So it didn't read analyst numbers, but you know, it's still positive EPS. Earnings per share, for those of you who are newer. So case, he thinks it's fair to include recent operating performance because the numbers reported in the last 7 years were quite impressive. EPS grew at 39.1% CAGR. New sales grew at 11%. These financial figures were obtained thanks to 6 intermodal acquisitions and improved margins in the brokerage business. Did not assume that net sales growth and EPS could grow at a double digit in the next decade. However, it's fair saying that the company did in the past. I try to remain conservative. So quite cheap. EV to sales stands at close to 0.6 times. EV to EBITDA is close to 4 times. Considering these figures, would be significant room for improvement in terms of stock valuation. So they're obviously have a lot of different brands that they're working with. And these are the different kinds of ways they work with these businesses. You know, whether it's their trucker load, brokerage, what value add and all that means. I have to look more into that. 36% of operating revenues from customers generating more than 100. I think I don't know if that's 100,000 or 100 million. So a while ago they had a Dutch auction, and at $28 to $25 per share, the shares are currently not trading far from 28 per share. A Dutch auction, if you guys haven't heard, it's a way to offer up more shares, and instead of just offering at like a price and letting the market buy it, people kind of like, well, I guess it is. It's still you just put it out there, and people kind of just auction off the shares, and it works like an auction, you know. So if no one's buying them, they'll get. It's just a way to get them bought, because the share price will go down, someone will buy it, and people keep buying at 25 if they can. Appears to receive payments from clients. When is this article? This article is recent, right? So the share count might be off a little bit for me. So once again, this is why my fundamentals are great, but you always gotta check with what's going on. Check the most recent reports, just to make sure that you got. So this is section always good for. Company operates mainly in the U.S. market, which can be affected by the internal economy. Transportation activities, the price of diesel fuel. Companies may be affected by fluctuations in the price of fuel-related commodities. As a result, I believe the free cash flow margins could be lower. So obviously, you got to check fuel prices, which they're low right now. Things are cheaper. I don't really know diesel exactly. I keep track of. I mean, I look at oil, and then I look at I know what it's to pay at the gas pumps here, and I have an idea that that's down. So I would assume diesel's close, but I know it's not always. I know it's not 1-to-1 as one goes. It's not a direct relationship, although it's got to be somewhat close. It just depends on. There's just different markets. Who's buying diesel and who's buying gas. So yeah, I mean, it looks like he did some kind of. If we divide everything by the 26.28 million shares, okay, so maybe my data is right, because he's saying about that median fair price would not be far from $33 and $48 per share. So he probably evaluates this somewhere around 40, which is kind of what I said, and then that's how he gets his with his range of values. He goes anywhere between 33 and 48. I actually like when people do that, when they give a high and low, and then you can assume that they think it's a fair value is around 40. I feel like that's how you should do it, if you have the numbers to do it. I just want to see what that debt is one more time. 486. We'll check, see what's going on with that debt. They filed on November 9th. Okay, so not that long ago. Long-term debt, current portion. So there is some operating leases involved. Just seeing, I always like to just check the cash flow statement, see if anything really stands out. CapEx is up, like that's one thing, jumped by 100. So, and that's the thing too, is you're going to see me check these numbers, and it doesn't mean I'm going to delve into it necessarily, but it's just something that I'll keep in the back of my mind. And then if I do decide to go deeper into this one obviously interests me. I would definitely need a pullback here, which this is the one that the chart was doing it, right? It was coming back. Just see what they. No, it's not much. It had a little pullback, but it's up. That must have been VOXX I was thinking of. So, this is such a great price to get in here. They even gave you the perfect spot for it too, and it's oversold and everything. So that's why sometimes you can just look at a chart. It's funny because you always see technicals and fundamentals arguing, but sometimes they're on the same page, and it's like when you see the technicals look great and the valuation seems reasonable, something to look at. All right, so that is composed of couple different things, couple of revolvers, term loans. They have some kind of equipment financing, real estate facilities. It's actually a little more complicated than I was thinking it would be. Looks like some of the maturities on 27. Facility matures on 2032. So they got a while. They got a while is what I'm trying to say here. You know, you can see interest rates are, just depends on what it is. So not terribly levered, to be honest, either. I mean, the reason why this is giving me an issue is because they just don't have cash on hand. So, but if that's the business has been run that way the entire time, they don't keep cash on hand. You know, it's flowing in and out, which just means that if they've been successful doing it, they have enough liquidity. They don't need to hold big chunks of cash. They're either giving it back or they're paying it off. You know, they're taking advantage. I think this is shareholder friendly in my opinion. So let's go. Actually, this shouldn't be that far from right here. ULH. Here we go. Oh, it's been a long time since I valued this. And to be honest, back then, my valuation, even a year ago, I've learned so much in this past year that valuation is just probably garbage. So don't look at any of these numbers. It's embarrassing. I'm gonna bump this right up. I like this. You know, I said good fundamentals, good management, dividend on deck, insider. We'll put owner, same guy. They're fine with debt. You know, buybacks, everything looks good. Buybacks and dividend. All right, just get some pricing here. This is pretty well run here. This is almost arguably like a good company, as in something that you could hold, which would go into a different one of my portfolios. But I do like this business. And I mean, you can just tell I mean, the whole point of this IRR return here, that's how this gets calculated, the IRR return here. You know, it looks historically extremely well run. You know, and I mean, look at this. It's green. I don't get to look at companies very often where it looks this pretty. They're pretty colors. That's how I do all my valuations, based on the colors. You know, that's how you know that you're right, is when the colors look pretty. See down here, over here, very, very pretty. Look at this. Look at this retained earnings, 46% now. What? That's compared to assets. That's pretty crazy. Just in my head trying to calculate, because I would say this is relatively bullish. Okay, I get 40.66. Anyone cares? Doesn't matter. No one cares. For my evaluation there. I get here somewhere in there, so it's just a little bit expensive for me. I'm gonna put a watch for pullback. You know, one thing I do want to throw in here is because of the kind of industry, it is cyclical. I should pay attention to that. It is affected by commodities. So all things considered, in the way that they've been able to run, they might not be able to do like right now. They're doing some buybacks and they're paying out that dividend, but that means they have wiggle room. So going forward, if let's say gas increases or diesel, and maybe trucking struggles a little bit, they can cut back on those things, which that'll drive the stock price down in the meantime. But if the underlying business continues to do well, as soon as those cyclical markets improve back, then they're once again right back in where it looks great. Their fundamentals look great. So I'm gonna throw this on my watch list actually, and by me saying that too. Obviously, I would need a pullback here, but this one interests me. This is a good company. I like it. It's doing all the things I think a good company seems to do. I'm actually surprised that there's not more. I mean, there's a few articles in the past, and everybody's saying the same thing. Favorable risk to reward. More. Well, this guy says ratings hold. This is from July. So it's good to check the bearish articles too, just to see if they can bring up something that maybe the other guy didn't mention. Okay, this is all stuff that we know. So is he saying the same thing? Fluctuations in economic can lead to varying demands between fiscal years. So historical gas prices. So this is obviously when they were going up. So he's just bearish when they're going up. Yeah, so I'll probably read into. So when I put something on my watch list too, I'm definitely I won't bore you guys on here, but I'll read through the transcript. Just to get a better idea of what management thinks, and probably read the recent 10Q and 10K, especially for these kind of companies. Sometimes I might not need that, like for Barnes & Noble. I read the most recent 10Q, but not much has changed there. I don't really need to go back and read years of history because it doesn't matter. The issue is something that's recently changed with the company, where something like this, and this is a historical business that I'm going to be watching over time. So one thing too that you can do here is this is a 10-year holding, and let's just compare it to just oil. We'll go to a 10-year chart here. So this is 2018. They had a big bump. So sometimes you can see if it's a direct reverse correlation, which it's not as reversed as I would think it was. It actually trends more closer to the actual price of oil, sometimes there's no correlation, which sometimes I get that too. Like I'm like, I don't really see much to worry about there. But this is an interesting one. I like ULH. Looks good to me right now. Obviously just a little expensive for me, but maybe one of my other portfolios, this would be something that I don't expect the same great rate of return, but it's also something that I would possibly hold for a much longer amount of time. All right, let's see here. Some good finds from the midweek. Yeah. helps to know too, like when you're screening through, because when I first started screening through for companies at times, you find ding dong here, and it's something that there's not much to go on. It's tough to value. It doesn't have enough information. It's foreign, and I get it. Sometimes I pull these up just to look anyways. It's been a while since I looked at them. I've looked at them before, so sometimes I just like to pull them up. But when you find 3 or 4 that are of the ones I'm looking at, and they are interesting for good reasons, whether it's going to be something I could even buy or not doesn't matter. It's more just if there's reason to be looking into it. Helps you to understand how your screening process is working. Do I need to improve? Do I need to start taking different things into consideration in terms of how I'm screening? Which metrics, just when I quickly look at something, tend to give me decent companies to look at versus ones that I pull it up and I'm like, this is pointless. Like this one, I can look real quick through here. Don't have much data. It's foreign. It doesn't have any earnings really. It has EBITDA of 12, or is that EBIT? Why is there's no EBITDA? So who knows? Who knows why this data is not even coming through? Barely any earnings comparative to what they're saying. It's telling me I need to massively deliver them in order to make this worthwhile. So just too much risk to even look into this one. Did it say Cayman Islands? Yeah. So it's also you don't even actually own the shares to this. Just sometimes when I pull up one of these, I'm not sure. Maybe it was just this. Maybe the chart or something caught my eye. I'm not really sure. It's just getting cheap. There's a few guys on here that constantly look at some of the like foreign stocks, like they're like always into China and stuff like that. Bamboo Works always is looking at all these Chinese companies, which you also have to apply a relatively stronger discount because the risk of return is obviously more serious with China, and I believe they're dealing with even inflation or deflation right now in China. So there's a lot of worrying things from the economy. Sometimes I'll just go. This is a really long final few paragraphs here. So he's just saying, there's competition. It's tough to grow. Ding Dong's ability to simply survive in such a tough climate puts it light years ahead of Miss Fresh, whose spectacular crash could be nearing an end. He's not giving me any reason to be bullish on this is what I'm getting out of this. So I'll continue to keep a relatively rough evaluation on this. DDL here. Portfolio models too young. We'll update. And this is like I said, I'll assign a relatively heavy discount to something like this. And the numbers they're all generous. I know I've said that a million times, but I think it's really important for you guys to understand when I keep saying that they're nothing here is locked hard in or not. Like that's why they are burning through cash here, and share counts come down, which is kind of surprising. That's not really moved all that much. So I mean, this really needs to start getting some kind of earnings before it's not considered extremely risky. I'm probably going to keep this at a 1 in terms of my comfort in one like this. It's really tough for me to value much more than that. All right, but that was the stuff from then. So let me go here. Let me just pause my stuff so it doesn't try and update all this stuff. We'll get rid of these tickers, and then we can update to today's stuff and just kind of get an idea of what we're looking at here. from Friday. See, hopefully there'll be something interesting in here. You know, we had talked about on just the dashboard on what's moving, what's not. You know, a few of the natural gas plays look interesting. That's why we had looked up, you know, there's the merger with Chesapeake and SWM. So it's a nice looking chart though, isn't it? Okay, so for the daily movers, we'll update this. We'll just go through. I just want to update just the different ones. I try and go through and update everything really quick because I've done it where I get looking at one section real quick before I update the next one, and then when I go to the next one, I forget to update it, and then I'm looking at the stuff from before I've already looked at, and then, you know, I'm starting to pick things out, and then I'm like, wait a second, these are the ones I just looked at. Is there anything going on in insiders? Insiders definitely had slowed down at the recent bit here. I don't know if I had seen too much going into here. Let me just scroll over a little bit so you guys can see all the way through here. I think these are basically the same ones I had looked at from on Wednesday. Nothing's really gotten bought that's really caught my eye. Besides the VOXX thing, but someone bought Tilray, really? Wonder who that was. This is a 2-year chart. I'm just always surprised. That's a pretty big purchase. There's 3 people in the last month. Yeah, I just don't know if it's enough to warrant any further looking just yet. Not saying it can't be, but just wondering why this gives me that instead of what I actually want, which is the description there. There you go. Weird error. See, how did it's right? It just doesn't. It just has an error. More glitches. Excel. Microsoft just overtook Apple. Well, I still have some qualms with your products here. I think a lot of this stuff could be worked on. Not that Excel doesn't do a million things, but it's probably the way I built it, actually. I'm sure someone could point me in what I'm doing wrong here. I'm just happy it works, to be honest. Speaking of working, let's save it because this is what happens. Right when I give Excel credit, I'm like, everything's been running smooth. The whole thing crashes, and then I lose all my data. Save my database here. This is the most important one to save because this is the one that if everything was to get deleted, at least I have my information here, and I could pull up the other stuff. The other stuff doesn't really get updated. It gets manually updated, like, you know, I bring in the tickers, but none of that matters. That can always be just refreshed, essentially. The database, that's the one that that information, if that gets lost, kind of SOL. Flex Steel. I think have I not looked at them? Wow, look at that gap up. Is that momentum or someone buy? We'll pull them up. Obviously trending higher, but looks good. This Qantas thing. Those evaluations are right. another one. Some of these companies doing well. You know, you can just go. Sometimes you can just look at some simple metrics, and you can tell which ones are doing well and which ones aren't. Just pricey for me. It's just, you know, getting in at these prices. It's probably a lot of these are growth investors, which is definitely not. That's probably, of all the things, what I'm furthest from, because growth investing. I just have a hard time predicting in that style. It's just not me. Just because when you're wrong, man, you get smacked on growth. Growth can really hurt you, and it's not like there's a material story that can turn around usually with a change in narrative from your growth structure. I saw EVA was up. I looked at them not long ago, but I'll pull them up one more time just because they're obviously trending towards lows. Another uranium company's up. You're going to see some of the stuff not come into my data. It just means in my bigger one it's not pulled in, but, you know, these are warrants and other kinds of things. So honestly, half the time I'm not going to even ever invest in something like that, so I really don't care if it doesn't pull it in. If I ever want to, I can go and manually add it in, and then it will populate everything, but it's usually not a big deal for me. But, you know, if you're ever watching and there's one in there that you're interested on, or you think you know something about, that you're just, you know, throwing me some tidbits, let me know, because, you know, obviously I miss them, and it's just kind of you just take it as a loss in the way you do the system here. CBD's up. Campiana. They're, I believe, a Brazilian, like, grocery type store. I've looked at them before. Possibly take a look there. I don't know why there's a 1 in that. I don't know why there's a 1 here. Oh well. Doesn't matter. I am gold. This is just track really close to the price of gold. I just want to peek real quick here at that chart versus actual gold. Let's do a 5-year weekly. No, not exactly. Are these more minors? It tends to exaggerate on the negative side when gold does bad. Just interesting. Does it exaggerate on the upside though? Just want to go a little bit further out. Sometimes it does exaggerate on the upside too. Okay. I might pull them in. Just because I've never looked at them and the metrics aren't terrible. And, you know, sometimes commodities are good ones just to take a peek at. What's Merck doing? Talk about one you could trade. So some interesting ones there. Pull them in. Already up to 5. Just from the daily movers. That could be might be a lot of research getting done. And I mean, we got the long weekend, so it works out well that there's a bunch of stuff to check into. It gives you the extra day to kind of not feel so rushed to keep up on things. I know people probably want me to look at the Bitcoin one. I'm not gonna. It's not my. What's the chart doing here? Oh, just like 1 year charts. What I want. It's generating cash right now, but just the valuation for that one's tough. That's tougher than even gold, in my opinion. To try and I mean, yeah, you can literally go off the charts, but I'm not trying to take small positions and figure out, you know, what it's going to do, to be honest. United Airlines is down. They're a little big for me, though. I don't know if I can see this. This market cap's a little big for me. I'm not going to pull them up. Just because ULH was super interesting, I'll pull up Frontier. Just transportation type things. All right, let's check out the weeklies. $12.29, is that of the end of this? I don't think I've looked at this in forever. What's going on here? This is really small, or really low in price. Got down to like 5 cents. Just take a peek at that one. I'm not sure if there's news going on there. Is Charge, is that the one that's like did I just look at these? Yeah, it's for EV. I did just look at these not that long ago. I'll pull it up just to see the bounce there. That one, no, I mean, it was down there, but at this, you know, it could keep bouncing from here too. So who knows? It's probably worth taking a peek here. The earnings obviously aren't quite there yet. This is young, right? There wasn't much data on this, 2020, so that's probably why I didn't have much of a valuation on that one. But well, I'll just pull it up just real quick just to make sure there's nothing I missed. Because I mean, it's a 144% move. So even at a small company like that, I mean, granted, that means the market cap was low, really low. So that's also kind of a deterrent. But you know, when it gets up to 50, and it says it has revenues of 640. That's more interesting to me. Catapult, that was a spinoff from IBM, which just hasn't ever panned out. Yeah, I mean, look, this is insane. Look at that. Look at that as a spinoff from IBM. Already pulled in flax steel on one of the other ones. That's the other thing too is I wish there was a way that if I had clicked it on one of my other ones, because sometimes it comes in here that it would maybe I could make it. I could probably put something in that, for instance, if this is true, the only thing is I don't want to make it where it has too many things, because if I click a check mark and then it turns into true and then it has to search the rest of the spreadsheet to find if it anywhere else has flax steel as already true in that in this, it's probably a macro would do that easier than just a formula. It doesn't really matter. No, I mean, I just need to pay attention to make sure I'm not an idiot pulling up the same thing more than once. But sometimes, you know, if you're pulling up like 20 tickers, it can happen. But I guess it doesn't really matter. It's been a while since I've looked at them before, haven't I? It's saying no. They're really small. You know, it's obviously a huge issue already right off the bat there. But I'll pull in that. Like I said, long weekend. We got plenty of time. Okay. So, whoops, wrong one. So this is weekly losers. So, Genius Group. Not so smart. Although this is back down. If you're a technicals person, this is where it bounces from. Oh, although a gap down, this is actually pretty bearish, I would think. Because 50s where there was actually a little bit of resistance around here. Maybe not. Maybe not. Maybe down here. Who knows? This is back to undersold. Obviously, it's all technicals for that. There's not much to say otherwise. But some of these, they finally start to get the stake in them and then just die. Just this cash. You guys are ever wondering how to know if something's going to really bounce? How much cash they got left? And then after they die and apparently go bankrupt, there's always one more gigantic bounce for some reason. But whatever. Not seeing too much here. Not seeing too much in these. These all look rough. I mean, some of them are trading a pretty steep to book. They have a lot of cash. Just seeing with this one. Oh, it's a blockchain. Okay, that's why I've. Once again, all that stuff related to Bitcoin, you know, it's like it's tough to get much of a grasp on it by using the fundamentals. That's what, so you know, since that's a heavy part of my thesis, that if I can't get that part, I'll tend to probably pass on it. So that pulls in 8. So we're good here. We can enable. Go in here, we'll update. This will start pulling in all the information for the tickers. It's about 8:30. I'll be able to keep going until about 9. So hopefully we can get at least into the first few of the ones of these and just kind of get an idea what's going on here. Did I pull up BNED? Why is BNED in here? Strange. Oh. Why does it say I am gold? Oh, did I click the wrong one? These tickers are wrong, or these check marks. That's why there's a 1 here. Something's off with this, because it's not pulling in I am gold. It pulled in BNED. I didn't realize that was the one below it. Which once again, I mean, if you look at my screening process too, you know, or I'm trying to find good cash flows, good earnings and stuff like that. BNED does not meet that qualification. So sometimes there's other things that come in here that. You know, I see the price to sales here and the revenues compared to market cap. Sometimes that's enough for me to take a peek at things too. I'll have to figure out what's going on with these check boxes. Sometimes for whatever reason they get moved around and then it's a pain to get the one to accurately reflect what it's supposed to. And sometimes when I was duplicating them, there's more than one check mark and one gets hidden behind the other. It's a pain. It's really what it is. It's a pain. But and now that I just undid that, it probably redid all my fundamentals anyways. So I have to make sure that this is actually Flex Seal. Yeah, it is. Okay. And then I'll just do under my ad hoc one, I'll just do this as IAG for now, and then that way it's pulled in. So it's a Canadian-based intermediate gold producer and developer company. The company's principal activities are exploration, development, and operational gold mining properties, North America and West Africa, Essakane, Westwood, and Côte Gold, Côte, I don't know. It's just talking about it's approximately 330 kilometers. It's just saying where they are. I think it would say the size of what it is. So either way, doesn't matter. But it does have a decent range of years here to kind of play around with. But with most miners, you got to kind of delve in. Sometimes I skip almost right to seeking alpha because the fundamentals and all are great, but I got to figure out what those mines are doing, what the expected profit is from them, and how mature are the mines, how consistent is the profitability from them, which a lot of times you can hop right to seeking here, and you can find. Let's close out all these charts here. So I've read both Taylor and Alberto's things here. Airstrike, rise, risk of a broader Middle East. So this is bullish for gold somehow. The one mine's 92% complete. So he's saying that could pay for better margins in 2024. Several others reported disappointing results with razor thin all-in sustaining cost margins. So that's why I said it's always about the margins with most miners. So you're trying to figure out. Obviously, the interesting thing here is if this is a mine that's super close to producing, it could obviously drastically change the way the company's earnings are. So reported 109,000 ounces, which is a 40% decline from the year ago period. Significant decline in production was related to the sale of its mine, which contributed about another 50,000 ounces. So the shortfalls with higher undertones mined at slightly higher grades as progress on rehabilitation work. Performances continue to leave a lot to be desired, with company-wide all-sustaining costs coming in at about $2,000 an ounce, up over 25% year over year. So that's pretty rough on margins. See, you can look here and see how material this affects things. This is from September, so this might actually be after, or my numbers here can be from before the article. On a free cash flow basis, I've got a lot of negatives going on here. They do generate obviously cash flow from operations, but it seems to get eaten mostly. Actual earnings looks like here are recently positive, but I mean you can just see what this has done to the business here. Just trying to see what their debt is. It's pretty high, although they have a lot of cash on hand. That is, so that's probably normal for the business, to be honest. Just to have that. I mean, they're going to have a lot of capex as they're working on these mines. Obviously, a capital-intensive business. So, all right, back to so more importantly, recent developments. Been mixed. They've skewed positive overall, starting with the negatives. I'm going to say Côte's estimated cost from its 2022 TR appears to be far too ambitious. 2.62 a ton. Mining costs likely to be sharp or high with 100% increase in explosives costs. So unfortunately, same trend will apply to G&A costs and processing costs we previously estimated. So just the whole process of getting this mine going is obviously more costly. I feel like this always happens with these mines. When does it ever benefit in the other direction where all of a sudden they're like, yeah, it was much cheaper to build the mine than we thought? Have a new royalty rate applied. Great. Not great. So it has a recent proposed acquisition of the remainder of the Nelligan project near Chibagabu in Quebec, or whatever that name is. Sorry to the probably Native Americans there, or Native Canadians. Do you say that a thing? Where there's currently 5 million ounce resource base. Overall, I see this as a smart move to improve its pipeline after chopping it down with the sale of Roseball and its Senegal assets to move in a primarily America's focused producer, which should help to keep its multiples to increase for the longer term. He uses to evaluate 488 million fully diluted shares at a share price of $230. Okay. So its price to net asset value is 0.75, an estimated net asset value of 1.55 billion, which is a reasonable valuation for the company set to bring a massive tier 1 jurisdiction mine online in Q1 of next year. Meanwhile, IAMGOLD trades at one of the lower cash flow multiples in its peer group, hovering near 3.3 versus cash flow estimates at 76 cents. This low multiple can be partially attributed to its relatively high net debt versus peers and its poor track record of production per share growth. Its exposure to Burkina Faso, which has lost investment attractiveness points with the worsening situation and the recent increase in royalties. Just want to know your number. Sorry, I'm just trying to see where he's just saying it's low on these multiples, but doesn't really give them out, which is fine. I mean, you don't have to state a number. Looks like other people are saying people are just saying that you could try and trade this and stuff, but until we know how the mine's going to work next year, it's tough to see what that's actually going to be. So tough to. I mean, you can see that's why that guy was saying to trade it. Seems to trade between 2 and 250 ish. It's not really my thing. I'm not going to trade this, but I don't think I'm going to trade this thing. But all right, interesting nonetheless. My valuation for something like this is going to be off because it's going to be tough to value this. Mine's saying just shy book value, but I'm actually surprised that's what it's saying. Just this free cash flow here is kind of killing things, and on average the book value just keeps going down here. I would probably imagine this book value is going to continue to go down. I mean, who knows? The new mine might change things. So that's going to be the big question here is what is that mine going to do? So follow mine Q1. Let's see here. Commodity, cyclical. It's got high debt. There's a lot of competition in the area. Just gonna kind of say it needs more. It's definitely worth the follow. It's a big company, there is some foreign risk involved. I'm just gonna give it a 2, just because, like I said, this one for me is gonna be really tough to value. Just looking at these numbers. I can see why my calculator is coming up around $4, but I think you should just the fact that free cash flow and net cash flow is usually, actually it's not too bad historically, but recently it is, and the margins are all down right now. I mean, look at the revenues are down half since 21. It's pretty ugly. So the big question is what is that mine gonna do? I'm just gonna look at the Dow one more time. I just want to see what that deck exactly is. Oh, of course it's this is from March 28th, so it's a while ago too. Assuming they so they have a credit facility and then senior notes. Am I able to see those notes? I keep clicking that dash. Every time these move around me, it always makes this impossible to find it. I just want to see if I can see what those notes are. See how they're trading. IG. These are the 5.75 ones. Yeah, I agree to their terms. Thank you. Last trade price is 86, so I mean they're trading fine. I mean I know some people might think 86 is low, but for me not at all. Strange. They're actually up from where they've been trading. Down at the end of last year, but back up. I mean, almost hit 87 there. So those are fine. Maturity dates 25 for that credit facility. Equipment loans are small, so I'm not so concerned about that. So with that being said, we'll just do a quick evaluation here. And then we'll go with I get 251 as my upside for this, which it's kind of similar I think to what we were just saying was trading, right? It was 250 is where I said about where the chart had gotten up to. I actually still think that's a little high. But either way, I don't think that's terrible for the time being. So then if I wanted to get my discount here, so we'd obviously need a significant pullback here, and just to follow the news story on that one, we'll keep an eye on it. I mean, it moves, but whether that's going to turn into anything, who knows? All right, on to Flex. Flex Steel Industries, manufacturer, importer, and marketer of residential furniture products in the United States. Company's furniture products business involves the distribution of manufactured imported products consisting of broad line of furniture of the residential market. Company's product offerings include a variety of furniture such as sofas, love seats, chairs, reclining rocking chairs, blah blah. Distributes its products throughout the United States, e-commerce and direct sales. Has operating facilities in a couple different places, and the company utilizes various fabrics in its manufacturing of the furniture. Okay. So it looks a little pricey right here, but not terrible. I mean, I can tell you right now, this is definitely pricey for me. The debt's a little high, but they did. If these are share buybacks, I mean, you're only talking 5 million shares, so this is something that can move quite a bit. You know, without the market cap needing to jump like crazy amounts with only 5 million shares. Is anyone buying this? No. They are paying a pretty solid dividend. Oh, no. Okay. I was just thinking of the price of the last one. Okay, 23, whatever. But, I mean, they're paying a dividend and doing share buybacks. Revenues are down. Looks like it was an okay trailing 12 months. Kind of actually better than it had been. We're doing real well back before COVID and all that. Like most retail type segments, you know, especially with some of this bigger type item stuff, I worry about, you know, with the housing market slowing down and also with more bigger ticket items. Not that some of this stuff is super expensive, but people are less apt to spend on these things as credit tightens, I find, for consumers. At least that makes sense in my head. I don't know if I'm right or wrong on that. Discounted due to debt. Send this down to the database. Just see if anyone's talking about it. 29%? What was the news on that? Expect net sales of Q2 100 million compared to 91 or 93 in the prior. EPS of 57 cents per share. Guidance in the range of 1 to 106, 107 to 112, and continuing in the forward year. So it must have been down for a little bit, and now it's coming back up. So just a real big move on that forward guidance there. They're saying 58 cents a share, and they had 295. Not terrible. This is old. I feel like I read this last time. Suppressed despite that. I mean, if they're buying things back and paying out a dividend, obviously it looks good. Well prepared for a potential downturn. So he is bullish on this? I'm almost confused on the way he wrote this. well created for long term. Yeah, I don't see too much in this. Yeah, either way, I'll need a pretty big discount on this. Just want to take a quick look at the most recent balance sheet. This is from 11/1. Cash just kind of remains steady. They have a line of credit of 32. The rest of it's all operating leases. So if that's the case, all right, then I would say that it would be around $28 is about what I would get. And dividends. I think management seems decent. It doesn't seem to has okay fundamentals. There's ownership. Let me see. He said 28% was what he got. Take a peek here and just see what this is. So there's a trust with a couple of them involved. All owning similar amount of shares. Okay. It might be then a family trust, obviously. So that means obviously, you know, it matters to them. It matters. They're shareholders. It seems shareholder friendly. I guess I can say good fundamentals. It's been historically ran pretty well. Everything got smacked in COVID, so I mean they had really this year was more of a rougher year. It got translated into this year too, but then they rebounded back in terms of metrics. $17.24. Actually, that's probably I'll go with that as my looks like, I mean, guidance was decent. I mean, it's like saying that it's going to stay at the level, so that makes me think that they could continue. I'll say get in there. I'll put this one on deck. This one's interesting, just in the fact that if we can get a pullback here, what was that chart at? Because I actually think, I mean, this got down to 15. I wonder what that big of a, what was the news on that one? Why November? Was it looking so bearish? I'll probably read the transcript on this one. Oh, they just had a rough quarter then. So this is the thing too, is this number could change quite a bit. You know, I mean, the guidance now is saying that. So when I start to pay attention to one like this, I'll check, see going forward if guidance is correct. If it's not correct, I will drastically drop my valuation for it, because that means that management likes to just talk. I mean, maybe something material comes up, but it's just doesn't give me the faith in it that I would like to have. Just wanted to pull this up so I remember to check this out. I'll read through that. But overall, interesting. The fundamentals aren't the best I've ever seen, but they're not bad by any means. And this leverage, this is operating leases, so that's part of the reason why I'm not paying attention to this number, because really these numbers should be higher based on that share outstanding. They do have the revolver line. You know what? That's true. They do have the revolver there, line of credit. So maybe it's not quite as high, because some of that is debt. So what did it say? 30. So about a third of it. So actually, if I was to do that instead as my valuation, times 2 would be 1.66. Gets me at 23.24 is what that puts me at. So actually, kind of where it's trading right now is what it's saying for me. I'll pull back just because, yeah, and then I get 1550 actually as a bottom, which is kind of in line with what the chart was saying, right? 15, not 5. Almost exactly. So, I mean, if they have another bad quarter, this is the thing to me, they have another bad quarter, I could picture it getting back down to this level. You can obviously see there's support at that level, so I can't be the only person valuing it somewhere around there. And we'll see what it does here. I mean, if it continues to break out on that guidance, then my numbers are obviously conservative. But I'm okay with that. Always okay with that, But this is an interesting one. Let's see here. I got 856. I won't dive too much into this next one, Frontier Group, just because, and it looks like there's probably not too much to go on this one just yet. It's a little young. And the airline business is always a tough business. But either way, interesting nonetheless. All right, guys. Well, we'll start to wrap up the stream then there. Definitely some interesting companies. Like I said, I think there's something there with Barnes and Noble's education. So, look into it yourself, see what you think. I think we're trending towards some lows here. Obviously, there's some serious risk involved. So, don't ever buy on anything that you've heard from me. But, I think there's something there. I think it still sounds like that thesis kind of holds in terms of FDC. Continuing to grow. I mean, some of it, the other thing too is a lot of it was contractual, so I know things could change based on the law and litigation, but as of now, these were contracts that have been established. So some of these forward guidance numbers in the 24 and 25 basically are at least in line to do that if nothing else changes. So we'll have to see. Obviously, really important to keep an eye on the news, see if anything else comes out of that. Yeah, we'll figure out from there kind of what's going on, and then hopefully that one works out. And the other thing too is if, let's say, there's some kind of bullish news that comes out, it could do the exact opposite and flip. Obviously, that's best case scenario. But some other companies today that we looked at too that added even something to the watch list on here, which I think this is one of the first times I've done that live on the stream. So definitely something else that I'll look into. Some of these companies definitely be looking for pullbacks to see if I can find something that gets closer to where I would be considered interested in hopping in. But I'll go through the rest of these. If anything else on here that I didn't get to today comes through, I'll talk about that on Tuesday. I plan on being on Tuesday, and we'll talk about whatever moved on Tuesday as well for that. So hope everybody has a nice weekend. If you're in the States, have a nice long weekend. If you get the day off, once again, sadly I don't. Part of healthcare, whatever. But see you guys next week. Once again, sorry Johnny wasn't on today. Guys, a party animal. Just couldn't make it. You know how it is. Get out there. But we'll have hopefully a good week coming up here. Just a peek at the portfolio one last time. Like I said, I'm pretty heavy adherent. I did trim a little bit just because, I'm starting to get pretty solid returns on that one. But that thesis still really holds for me. I still think there's some serious upside to adherent. Alto's starting to become a little more interesting again to me at these numbers. I saw Justin was talking about some of the crush margins coming through, and that corn production's been like ridiculous. So a lot of that is going to be there to possibly to benefit. And I know that thesis got rocked. Management really needs to come out and just because this week too, the price. I mean, we're down to 218 right now. That's crazy. It's crazy to me. 218. I'm honestly pretty surprised by that pullback. So another one I keep an eye on. I know as we've said, Johnny's in this one, so he's I'm sure he's keeping an eye on and possibly maybe adding here. AIDS is one I've trimmed, but still bullish on that thesis as well. So far the start of the year has been great. Had great success already, and hopefully with the Barnes position, obviously you can see it's a significant amount of the portfolio. So if it can lock in some gains here as we go forward. I might do that just because of the size of the position. You do have to maybe consider trimming, but I just think if that thesis stays in place, that could be a multi-bagger even. So I'm pretty excited about that one. We'll see. I'm interested to see what Courage is. I don't like his subscription service or whatever it is. I don't pay for that, so I don't know exactly if he's thinking the same thing kind of I am or what other people in the field are thinking. But we'll see. We'll see going forward. You guys have anything, comments, questions, please throw it in the comments or whatnot. But other than that, everybody, hope you have a great weekend. Thanks, guys. Don't got much left, but cheers.